when we think of alts, we think of it for the incremental risk, am I getting the incremental return?
Welcome to today's Land and Everything Else podcast. This is Dr. Craig Lemoyne. I'm here with John Lavery of Emberwood Capital Partners, and I'm so excited to be here today.
Craig, I'm so excited that you and Presley decided to come straight across the state to.
Oh my gosh, it was a lot of fun.
To the border.
We love it. I just want to shout out, y'all have been supporting our program for 5 or 6 years, and we appreciate it.
Yeah.
And thank you so much for all you've done for us.
Yeah, we really view the support and the growth in our industry is a really critical thing, and you guys are doing a great job. So we're happy to do it.
Well, thank you. You've helped make it better and brighter than it would have been. That's for sure.
Thank you.
So, I wanted to come down today and talk with you on a couple of elements. First off, why don't you tell me a little bit about the firm, what you guys do?
Yeah. So, Emberwood is been around pushing 35, 40 years, so like I'm a generation 2, worked with my father in the business, been doing financial advising and heavy on the advising side probably for the last 20 years, which is a little bit unique. I still see a lot out there that aren't on the advising side. I would say our critical market is that mass affluent market, probably with investable assets somewhere between $500,000 and $2 million in net worth. And then, we've got clients who we buy boats and planes and other things for, developmental land in Colorado and cool things like that. So,
and where y'all located for everybody?
Yeah, we're in Quincy, Illinois.
Yeah. It's beautiful here.
Thank you.
I kind of like it.
Yeah.
I got to be honest. I wasn't sure like what it would be like. And we drove in and I'm like, this is nice.
Yeah.
This is like small town meets big town meets river.
Yeah.
It's quite lovely.
Thank you.
But I wanted to talk today on Land and Everything Else. What we try to capture, explore, and study is the idea of kind of moving beyond traditional stock bond, open and mutual fund investing.
Correct.
Right. And that's kind of been in the RIA space, 90s into the 2000s kind of been what we do. But we see more and more, I think, as clients look at other types of assets from real estate to land holdings. And I was wondering if you share a little bit about your perspectives in that and where you've seen the world going.
Yeah, it's interesting. Like the number of publicly traded companies has just continued to decrease. I think a lot of it's around regulation, for companies that, and private credit, private equity has kind of exploded. So in our area, it's a big ag related area, so lots of people have money tied up in farmland. So that would be one of the areas that we counsel on.
So when it comes to farmland, the challenges working with farmland, right? You have an asset that has experienced a historical appreciation period over the last decade.
Yeah.
At the same time, you're currently challenged with sort of an interest rate yield dynamic that's interesting, right? And then the third part I think about all of it is you have a relatively illiquid asset that tends to change hands rather infrequently. I think the number that I've seen quoted is around 2% of farmland trades hands in a year in the United States, and that leaves 98% that doesn't.
Correct.
So much.
Correct.
So when you're having some conversations with clients that have farmland, just if you want to walk me through how are you addressing some of the liquidity issues? How do you talk about, do I borrow to buy more? I mean, if you could give some generalizations, that would be fantastic.
Yeah. I mean, there's a lot of different ways we can go. So we'll work with farmers who are also kind of like a second generation.
Yeah.
They're looking to say, hey, I farmed with mom and dad. I've got my own land, but I really want to acquire more, more land. And a lot of that consultation goes to really pro forma, type work on what's the financial statements look like, and with the current interest rate environment, does this pencil out? And then you've also got pressure there from leased land that, equipment is so expensive. It's like, am I going to keep my equipment rolling in enough acreage to really make this thing a go. And that's an interesting, dynamic too. So I think that's one side. And then the second side for the farmer that the kids have moved away, right? And that they're not going to be in the business. How do we kind of talk and deal with that succession plan or that exit plan to the business? Is it a sale? Is it an outright lease? What's that look like?
Walk me through that first point you made. We talk a little bit about economies of scale in farming, right? And I think for any advisors or agents listening in, just to give some perspective.
Sure.
My first experience with economies of scale, I went to the Farm Progress Show in Illinois and Indicator. And I had a grain and seed company had me out, and they're like, "We want you to talk about estate planning for farmers, and we're going to put you in a tent, okay?
Sure.
And you're going to give that same 15 minutes, and you're going to do it 4 or 5 times, right? And we're going to try to get some farmers to come by and say, oh, here's some estate planning tips." And my whole thing was around building a team and the fact that you are inevitably gonna need to acquire some estate planning, lawyers and life insurance costs on the front end, but then on the back end it's better. That was my little shtick. But we talk about economies of scale, and I remember I walk in here and there is a tractor with wheels bigger than me. I'm 6'4", right? And I'm looking up at the wheel of this thing, and I'm just thinking, like, this thing must cost like $2 million, like handily, right? And so when you talk about economies of scale with clients, walk around that. Like, is there an acreage number where you start to get a little more comfortable? Does it just depend?
I really think it just depends. I mean, for me, I was an accounting major, so it goes back to like cost accounting,
right? Yeah,
nerdy stuff.
Dive in there.
We got to keep the wheels rolling on this thing because just the capital expense is really up there. So most farmers at this point say that you got to really farm. You're small if you're farming a couple thousand acres.
No, I mean that's the truth though, right?
Correct.
And I think there's some real realities to that. And I've reading of course, land without improvements worth more than land with improvements, right? To some extent for that economy of scale.
Sure.
But a couple of thousand, that's really interesting. Let's pivot a little bit towards estate, if you don't mind. One of the challenges I think we have with alts in general, real estate too, would fall under this umbrella, is here's something that isn't valued that often, that's worth an awful lot of money, but you can't easily get cash out of it. Right? So when you start looking at estate plans and you're looking at farmers or your clients that may hold other types of real estate positions, I guess we're going to share a little bit who's on that team. What does that process look like? And
we like to look at ourselves as kind of the quarterback of the team.
I like that,
if you will.
Yeah.
But we want the attorney involved. We want the CPA involved, and potentially we want that next generation, right? A son or a daughter involved in the conversation too. But and I really think it starts from ownership of each tract of land. There's many times that we'll come across and somebody's got way over the Illinois estate tax limit. And I'm like, how do you own your land? And they're like, joint. And I'm like, we need to do something now.
Walk us through, why is joint bad in Illinois? Why are you going to get
in
hit?
Illinois, we've just got a $4 million exemption. if one of you dies, simply put, it goes to the other one. So we don't get,
there's no portability or anything like that.
Don't get to take advantage of it. So yeah, it's something that, for a lot, just doing basic trusts and titling tracts of land in the correct trust is a big step towards minimizing the estate tax bill.
So let's talk a little wealth management.
Yeah.
If you're comfortable with that.
Sure.
So when we look at somebody that's got real estate or alt in a position, give me some perspective. If I come to you and I'm heavy in stocks and bonds, let's say 95% of my net worth is in stocks and bonds, and I say, I'm looking at something different, be it an apartment building, some sort of maybe private investment or capital group. How do we evaluate that decision? How do you go through? Is this a good decision, bad decision? Do we stay with the stocks and bonds?
Right.
Do we look at it? What kind of processes you guys use to look through things?
Yeah. So I kind of break things down to alternative assets and think of alternative assets might be today, the financial markets are so good at coming up with products that you can do almost anything, right? So if you want gold exposure, you can buy the GLD ETF, right?
Sure.
You don't need to go get gold bars and put them in your basement. Crypto assets, there's a kind of a newer asset class, but now crypto is in essence electronically traded. So we would term those as liquid daily.
Okay.
But an alternative asset. You might not track stocks and bonds. Where alternative investment, right? I probably am focused on things that have more liquidity issues around them. And farmland might be, is one of those, right? That just like a private equity fund might be too, that, hey, you stick money in this, you can't call or liquidate the next day and get your money back out.
So the important part is educating clients around liquidity premium.
Correct.
Right. That's going to be key to this decision.
Correct.
Is okay. Now understand that tomorrow you can't go to cash here.
Yeah, absolutely.
Do you find some pushback there or comfortableness, or kind of where have you seen those conversations go?
In general, people like to be able to grab their money.
It's true. And I think that's where we see in my view of this world, we've seen alternatives. And when I say alts in this context, we're really looking at things like real estate or land or private equity, flat out private equity hedge fund.
Sure.
We've been very comfortable in the institutional space. We've seen them used in insurance company reserve accounts and in state pension accounts and other types of DB plans. We're very comfortable there because we can time liquidity premiums pretty much, right? We can time liquidity events.
Yep.
I think we're starting to see that roll down, and maybe it's a function of tech and reporting and ease of access and costs getting in to the family office space.
Yeah,
right.
For sure.
The airplane client space, I guess would be a good way to say it. Right. We're seeing more alts kind of flow to that, but I also think there's a real dynamic here that if you've got way more than enough money than you ever need to retire, there's some you're just not going to touch. And I think that's just sort of a common sense dynamic. But are we starting to see that third layer roll down then? Are we starting to see that $1 to $5 million client that's now we have products that they can get that maybe 20 years ago we couldn't get, and those may have some liquidity premiums on them.
So definitely so. And I'm now just past 29 years in the business, right? It is all the big boys are coming down to play in that space, right? So Apollo, KKR, Carlisle, Ares, you're seeing them play in that space where Apollo, for example, to be an individual investor in one of their funds, you need a $10 million commitment as an individual to get into that fund. Now those are available on platforms at a $250 to a $500,000.
Yeah, no, you're starting to see that roll down,
and which changes the landscape a lot.
It does. But I think having the liquidity conversation, that's so important to remind everybody that I always think of my dad. He's 85 and he's been in mutual funds and stocks since the Navy, right? And so that put that together, right?
Sure.
But I always think would Bill understand if he bought in a hedge fund, right? And I go through that in my head, and I'm always I don't know if he'd understand that your money's locked in for a period of time. Yep. So it's good to bring that up. And the other reason, of course, is then the attractiveness of it is that we're trying to do asset allocation plays,
right?
And I think that while we don't know the market goes up or down, and I kind of avoid it, I'm a very boring investor. I just invest every week and then I'm done.
Yeah,
and at some point in the game, I have flexibility, right? That's my whole take on it.
Yep.
But I do think that asset class correlation metrics play in when we look at that space.
Yep.
Have you seen some of that?
Yeah. Different allocations can, and you typically see this, if you read in white papers that a 20 to 30% allocation can, decrease that standard div and increase return. And that's kind of where we see the sweet spot for a higher net worth person that can absorb the liquidity. But really, when we think of alts, we think of it for the incremental risk, am I getting the incremental return? right? So like one of my big things with people would be like, you can't invest in a real estate fund for income only. And it's like, well, the distribution rate is 6 or 7%. You know, it's like, well, what are you expecting to get out of it on the back end, right? You know, that you've got to go, why do I own this? And what's my expected? Things don't always work out, but what's my expected level of return out of something, right? And if it's, hey, I think I can make 15% a year on something, well then, okay, then maybe it's worth some illiquidity.
But I like that. I like how you framed it, right? Because in the first part of your comment there, you talked about taking a long-term, like, what's the end game? And let's back up from that.
Yeah.
Right. Is this going to go to kids? Is this going to go to charity? Mm-hmm. Is this going to, like, what is your end game? And then let's back that train up. You know, I like that approach to conversations. I think that's strong.
And I mean, I really think from a wealth management standpoint, it's like everything you own, you should consider, why do I own it? And I'll counsel a client and say, it can be a convertible. And you could say, I own it just because. And that's cool, right? But you got to understand, in today's higher interest rate environment, right? When I'm talking about with a client who's got a plane or a yacht, right? And you've got, or a collection of cars.
Sure.
You've got so much money tied up, multiple millions of dollars in cars. I mean, you can get 5% in treasuries today, right? Are they going up collectively at a 5% clip every year? So that's where interest rates have like really kind of shifted, you know, the thought process around, and farmland's another one, right? Of like, what kind of appreciation am I getting from this?
Well, and I also think you make the point of, you know, it goes back to PhD land really fast for me, right? Because all I'm going back here is this idea of utility function, right? Is this like, what do I derive utility and happiness out of?
Yeah.
But I think that there's some tough reality conversations in this space around that utility premium, right? Is I always had this thought, like, you know, you're driving, you're going on vacation, maybe you VRBO a farmhouse, you have this great weekend. Mm-hmm. You're like, oh my gosh, I want this life. I would get so much out of it. But you're like, yeah, how much do you want to spend for that? Right? You got to keep this thing up. You got to deal with it. You kind of, we really want to run to homes, you know, a house and a homestead, that kind of stuff. But I think utility plays in. And when you're talking about cars and boats and those things, you're like, yeah, they are in a way. They're very much and all, right? Just like a baseball card, right?
Sure.
But when you start having significant value in it, then you have to have some scarcity trade-off conversations. So you wouldn't call that to the client, right? I'm not going to walk in with that framework.
Right.
But I do think that's a great point, that it's your risk-free rate is here, inflation's here, risk-free rate's here. And what then, you know, you really want to hold this car collection, and how much you paying to maintain the car collection? And, you know, is that, are you getting enough utility out of that? And then your comment on long-term framework, right? Like, what's the end game?
Right.
Because what's the end game of your car collection?
Yeah, and the answer can't be just keep buying more, right? Like at some point, because you're like, well, what are we gonna do with these? And I don't know that it's any different than a stock portfolio, right? If you buy your own stocks, I'm like, hey, at some point when you get over 25 different names, are you really keeping track?
No,
like you're not.
No.
Right. So, you know, you go, hey, I got to get rid of one of these before I can buy another one.
But I think with a stock portfolio, it's more easily liquidated by your kids one day.
For sure.
Classic car collection.
For sure.
Where they may not be in the know. They may not want to maintain them.
Right.
It may be a storage wars thing that happens. I mean, like,
correct.
The stock portfolio is a better beneficiary asset than the cars. Sure. So I think that's a great point you make on alts. You know, when we look at that, I think percentage of portfolio value comes into play too, right? Am I a billionaire and I have a $4 million car collection? Does it matter? Probably not.
Yeah.
Right. But if I'm worth $10 million with a $4 million car collection, that's a totally different matter.
Right. Yeah.
So that's kind of fun.
Yeah.
I like that. I like
fun stuff to play around with.
It is. So let's kind of pivot on process for a little bit.
Okay.
What process do y'all use when you're looking at public and private market investments? What process do you say, this is something we want to offer up to the customers, clients? This is something we're going to pass. Walk me through that.
Yeah.
the investment management process?
Yeah, I think it starts with history. Investment history with the company. How many programs have they done? What's their history in the space? So track record's one thing, but also history and how they treat investors. I think that is a great starting spot. And then, really looking at what is the typical life cycle of the fund to be able to educate clients on, hey, this is likely a 8 to 10 year old, 10 to 12 year old, that they got an idea there.
Do y'all have a committee that does that kind of setup?
We do. Yeah. We've got an internal investment committee. And then we've also used, now in the financial advising industry, there's platforms. And so Case is a big platform. Typically our alts are coming off of Case's platform, and they're doing a lot of the due diligence.
So they do a first round vetting.
Sure.
You're doing the second round vetting.
Correct.
Before you share with the customer.
Yeah. Correct.
Yeah. Well, that's smart. I like that.
Yeah.
So what do you think I guess to some extent, where do you see, 10 years down the road? Are we still looking at alts? Are we back to mutual funds? I always wonder if is this a trend or is this forever? I don't know. I'm stuck with that one.
That's good. It's a great question, Craig. I think alts are they're here.
They're here.
They're not leaving.
No.
But tons of people have gotten in the space. If you look at multiples that firms are paying for businesses, they're stretched, similar to financial markets, being stretched. And so the cautionary tale right now is some stuff's not going to do well.
No.
Right? They're not going to do well. I follow Apollo really close. Apollo has a whole area that set up for secondary market buying companies out of funds that need to liquidate the fund, and they're going to go in and bottom feed the fund for a lower price because they know there'll be disruptions in the market, and they want to be there ready to step in, to buy.
I mean, that's an incredible capital market solution to a capital markets problem.
Correct.
Right?
Yeah.
Like, I love that. That's
it's the Wayne Gretzky skating where the puck's going to be.
It is.
Right?
It's a very clever way
Yeah.
of being ready.
Yeah.
So, I mean, that's the world. I think, we've seen technology and platforms make what was, much more accessible than it used to be. I don't think that's going away. I do think as volatility enters the landscape, I think there's some pros and cons to something that's valued less often, right? Like, it sucks when the market's down 3% to look at your portfolio that day,
right,
and be like,
day change.
My goodness. You don't see that. With that's one advantage to a more liquid asset is that you don't see those daily ups and downs, which I guess there's some comfort to be had there from a psychological standpoint. Yeah, there's something to that. I mean, it can bite you in the butt 5 years down the road, but there's not the daily, like, I'm going to go check right? That's not a good feeling.
Yeah.
No one likes that.
Right.
So if you were giving a little advice to a young advisor, right? I always like to kind of end with this question. A young advisor starting out in the wealth management space, they want to learn a little more about investments overall, public equities, funds, bonds. They want to learn a little more about alts and getting started. Where would you send them? How would you go about obtaining that knowledge? And
we would start probably with an accreditation, right? So we have multiple CFPs in the office, and you can go to their board. I am a CPWA, so that's Investments and Wealth Institute. So you can go to those areas, and those are great unfiltered spots to gain some knowledge, right? So the cautionary tale is when you start going to a company, there's always like this bent, right? And my deal is like follow the dollar.
Right.
They'd like you to sell their products, right?
Sure, no question.
So I think it's some of that, I would start probably there. And then, conferences are a great place to go, beyond that, to really learn more.
I like that. I think you're the first person to answer conferences, actually. Yeah. I like that answer. One other thing I want to talk to you about, because we were kind of chatting offline. Tell me about your coaching group you go to. Tell me about coaching. You see, coaching is one of those things where I think young advisors don't really necessarily have the bandwidth for coaching. Maybe they need it, but they don't always see the bandwidth, right? I've got pressure on the client side. I've got pressure on the performance side. I've just started.
Yep.
But talk to me about coaching, values you found in it, how you went about finding a group. I'd love to hear that.
Yeah. So I am part of a coaching group with one of the best coaching companies in the country, client wise.
Okay.
They're out of the Dallas, Texas area. They do the Barron's Teams Conference and speak at that. But my group is really 15 to 20 advisors, people from all over the country. So California to Boston to Texas, and so you get the different geographic things that are going on. But really the focus is how do you grow enterprise value of your firm?
Okay.
Right? Do that through serving clients. So Ray, who runs and owns ClientWise, always says, this is a noble profession. And we want to do what we can to really further that, So, I've done it for 5 or 6 years, and it's kind of also a great way, I think, to unplug for a day, a quarter. I fly to Dallas and am in a meeting and got tons of stuff to think about on the way home.
Yeah.
So it's great.
And I think from a partner ownership standpoint, right? That's something we don't teach in school is how to run a firm. No, we don't teach that, right? We're too busy teaching the base, like here's how to be a financial planner.
Sure.
We're not teaching you how to run a, 5, 10, 20, 40, 100 person firm.
Correct.
Right. So like all that I think is where coaching adds just huge value.
Yeah.
And you enjoy it. You want to keep doing it.
Yeah. It's been great. And just something that we really think is needed, because the firm is only successful to me. I can make a good living, but I want it to be good for that next person that's buying it. So it can work out good for me financially, but I want it to work out good for them financially too. And that's really, the service model that we put in with clients. That's just kind of part of it.
I love that. Well, thank you so much for talking with us today. That was awesome.
Thanks for coming.
Thanks.
All right.
Bye-bye.